Hey, everybody, the Fed has not cut interest rates yet. Surprise, surprise. No one really thought it was going to happen this quick, but it looks like it might be a little bit longer. So, Tyler and I are going to revisit what we think interest rates are going to do in 2024, see if our opinions have changed a little bit, and what we think it could mean for the stock market. Clearly, the market has kind of shrugged it off because the stock market's still very close to an all time high. Um, but before we dive in, take a minute, click subscribe to my channel, and check out the link you see on your screen for a message from our sponsor, The Motley Fool. It's the best way to support what we're doing here on YouTube, and you can get the top 10 stocks to buy right now. So let me get the painful part of this video out of the way quickly. Tyler was right. Tyler has been right
So
so
far,
far when it comes to
thoroughly.
interest rates. And what I mean by that, neither one of us thought the Fed was going to cut rates yet. I don't think either of us are surprised that there hasn't been a rate cut to this point. But what Tyler's been saying is if we get a lot of rate cuts, it's going to mean that the economy is doing poorly. The economy's been generally doing better than expected. It's not just that inflation has been surprisingly high, which I mean, inflation has been higher than expected in the past. That's why the market kind of, took a dive last week when we got some new inflation data. But the economy's doing well. I mean, the job market's doing well, unemployment's doing fine, wage growth is looking good. In pretty much every major metric, the economy's been very resilient in the sense of absorbing all the rate hikes that we've seen in the past couple of years. And I think that's what's really surprising people, including the members of the Fed, who now are kind of being really cautious about wanting to get inflation down to their 2% target. Because if inflation was still a little elevated, which right now it's in the 3% ballpark, a little high, but not the 8 or 9% we were seeing in 2022. If inflation's elevated, but we're starting to see unemployment spike, we're starting to see, wage growth moderate, things like that, then maybe the Fed would be a little more eager to cut. It really doesn't feel the need to do that right now. Selfishly, as someone who invests in a lot of stocks that would be affected by by rate cuts, I would love for them to do it now. But let me go ahead and stop ranting. I'll kick it over to Tyler, and so he can take his victory lap and things like that. Um, Tyler, I know you said, I believe last time we talked, and correct me if I'm wrong, you were saying two or three rate cuts in 2024, kind of an expectation, broadly speaking.
I,
Has your
maybe.
opinion changed? Has your opinion changed in the first 2 months of the year?
No. Not to bury the lead in any way. Look, I don't want to do this as a thing of gloating because, like, look, I'm pretty much all. I don't short stocks. I don't have any short positions on anything. Everything I own is long-term stocks, both public, private, and cash. It's not a thing of like where it's in my best interest for interest rates to stay high or for things to go higher. But I think what's important here is the idea of conservative underwriting of your investing, of just like how you plan out what you're investing in. And part of the reason I was saying these things earlier is because when you go to make your investment decisions, you really shouldn't be betting on fortunate outcomes that may or may not happen. If you can, make an analysis of the current situation that you have on the stocks that you own. We talk about real estate a lot. Real estate uses a lot of leverage, so it's highly dependent on what kind of rates you're looking at for debt, future debt, or when you have to refinance debt. And so when you go into these situations, when you're looking at trying to analyze these sort of companies, in my opinion, it's better to be conservative and say, look, there's a very real possibility that we may even see rising interest rates. How would these companies do in that sort of event? Because of course they're going to do great if interest rates get cut. Like that's like a given. And so rather than trying to bet on that outcome, if you can find stuff that are, meet sufficient investment criteria before you even get to rate cuts, then you're probably onto something because those will do well in the higher rate interest environment, but also will do well in the lower interest rate environment. And so that's the message I want to convey when we talk about interest rates here, more than anything else. Like, again, I'm not really 100% sure where we're going to go one way or the other. I just read something on Bloomberg, I think it was a couple days ago, where they were talking about there have been hedging bets from, big institutional investors who are actually now starting to, build some hedges in that we might see a rate increase because we're starting to see some upticks on a couple short-term headwinds. I don't know how many people have been following what's been going on in the Red Sea lately, but traffic that has to go around Africa instead of going through the Suez Canal, it costs more money. And those that do want to go through the Suez are paying much, much higher interest rates. And uh, as a result, we're starting to get some stickiness in supply chains with like where containers are located and how we're going to get products from one place to another. And, one of the big components that they've been talking about with, inflation, things like that in the last couple of reports is that service inflation. So people employed, people getting higher wages, all of those things have been the harder thing to tackle when it comes to inflation. Yes, we've seen a lot of goods inflation rates go down precipitously, but that services level, and that's where it's been a little bit stickier, a little bit harder. And you and I, we follow housing. Housing has not really subsided in any way. Housing prices are still increasing, and rents are still increasing. So when you consider these things, there's a lot of pressure that's still building on the inflation side that is going to be hard to tackle. You hear a lot of stories of like Facebook layoff or Meta layoffs or Google layoffs and things like that, but it seems like the layoff phenomenon is very isolated to tech. Probably a little bit of the hiring binge that they had during, the coronavirus pandemic. But outside of that, looking at industrial companies and things like that in the United States, construction's way up, industrial output's doing relatively well. There's a lot of non-tech hiring going on that, kind of portends the idea that we may be stuck here for quite a while.
Yeah, and I mean, it feels like a lot of investors have really soured on the prospect of a rate cut happening within the next few Fed meetings. Um, I'm looking at the CME Fed Watch tool, which kind of just tells you how investors are pricing rate cuts into the market. At one point this year, there were as many as 6 rate cuts being priced in by traders. And I know you called that ridiculous at the time, whether it was privately or through YouTube, one or the other. You said it was kind of ridiculous. Um, it turns out you were probably right. Now the median expectation is about 3 rate cuts throughout the year, and kind of my prediction is whenever it starts happening, the Fed won't do it until they're ready to commit. And what I mean by that is when you think about how the rate hike cycle happened with this Fed leadership, the rate hikes, it's not like the Fed raised rates by 2% and then just waited for a year to see if how it affected inflation, anything like that. They raised rates at one meeting by 75 basis points, the next meeting, very rapid succession. So I think that they're going to want to cut rates in a similar fashion. They're not going to want to make a quarter point rate cut just to do one and then let it marinate for a little while and see how it goes. They want to be confident enough that their plan is to kind of do them, not necessarily at every meeting, but in pretty rapid succession. And I think that's the big delay. And that's what investors were kind of missing at the beginning of the year. Like the Fed's just going to cut just for the sake of cutting and let it and see how it goes. I think we'll get a rate cut in June at this point. I think that at the June Fed meeting is kind of where I'm looking for rate cuts to start. Neither of us have a crystal ball. Um, that there's no crystal ball in this stack of papers behind me. I don't see one on Tyler's bookshelf. Um, I I think we're going to get 4 total, and just the reason I say that is because of the point I just made, in that the Fed is going to want to be confident enough to do rapid succession. And if we get the first one in June, I think they're going to do quarter point, very rapid succession, maybe a percentage point of rate cuts total, and then see how it goes and how the market's doing. But I don't think they're going to start until they're confident that they're going to be able to do a few, and I don't see them starting any earlier than June. I think we both agree that interest rates are going to drop eventually within the next couple of years. We're going to get some significant rate cuts at one point or another. Um, and I think that gives long term investors like us an advantage. Tyler said if you could find great investment opportunities now in this kind of environment, you're putting yourself, in a great position. I also think if you have the patience to look at sectors and companies that are affected by higher interest rates and are willing to wait until they kind of drop or normalize, whatever word you want to use, like real estate, we talk about all the time, is a very rate sensitive area, like REITs. Then you can also put yourself in a great position. But I think the interest rate environment, and I'll stop after this, has kind of created more of a long-term investors market than a traders market. Whereas for a while during the zero interest rate time, it was a lot more of a traders market in a lot of ways. So I think long-term investors have a bigger advantage now in a lot of ways than they did when money was essentially free. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.